Good day to all. This is the second part of our discussion about valuing bonds or bond valuation. Now, our first step will be the types of bonds by issuer or issuing company. The company here or the corporation is the one that is issuing the bonds in order to get sources of financing. As we all know, or as we knew that bonds is one way, or issuing bonds would be considered as one way of sourcing or outsourcing for financing coming from external sources, of course. So we just have to take note that these bonds have been issued by the issuer, but then this is on the part of the investor or the investor that buys or that buy such particular bonds. And these are the different or various types of bonds. We have corporate, municipal, treasury, and agency. And they differ with certain aspects. So example, for corporate bonds, basically these are the bonds issued by corporations, usually with par of $1,000 and semi-annual coupon or interest. Now we just have to take note that this is in US, so it's possible and probable that we are borrowing some aspects for Philippine purposes. Bonds, if maturity is greater than 10 years, and then we call such as corporate notes if maturity is less than 10 years. So they have the same impact or effect or classification or description as notes. So basically, if we say bonds, this is actually similar to a promissory note wherein there is an unconditional promise to pay, and that is with certain number of years and then stated values or amounts and nominal interest. It's just that they differ in maturity. And we will know that more in treasury bonds. For municipal bonds, these are the bonds issued by local and state government, and the interests are normally tax-free. For treasury bonds, we just have to take note of three terms. Treasury is issued by the finance department of the government. So we have maturity of less than 1 year. We have the treasury bills. If example, the maturity is more than a year but less than 10 years, treasury notes. But if 10 years, treasury bonds. Note that these classifications, which are three though, are closely related with corporate bonds here. There are just no corporate bills then. Then for treasury bonds going back, these are used to fund budget deficits. So a deficit or deficits would happen or occur when the budget expenses or expenditures are greater than the budget revenues or the budgeted revenues and inflows or cash inflows. In addition, we have the agency bonds, so issued by government agencies. Then we have the following. In the Philippines, we don't have much of the agency bonds because normally, or as we speak of bonds, it is the government, the Republic of the Philippines, that issues the bonds. Then to continue, what about by features? We have fixed versus floating rates. If we say fixed, clearly the rate is not changed. It is stagnant. It is unchangeable as stated on the document. Although this is in consonance with our discussions so far with respect to discount rates. So it doesn't mean that the rates are fixed, that we do not apply anymore the effective rate. So that could be one question that can be asked. This is just a classification with respect to the nominal or stated or coupon rate. On another hand, we have the floating rate bonds in which the coupon is tied to prime rate, LIBOR, which is the London Interbank transfer rate, and then we have the treasury rate and then the other interest rates. So floating rate is the benchmark rate, whatever is provided, plus the spread, and the spread is the difference. Also, we can consider the transaction for the inflation or the tips. So we have the inflation rate also to be added to the value or to the percentage of the rate. So tips, for example, for the inflation. Next would be secured versus unsecured bonds. When we say unsecured bonds, also known as debentures, they don't have any collateral. So they are backed only by general faith and credit of issuer. Basically, it's just a matter of knowing the credit standing or the credit position of a certain prospective client, and upon knowing that such person has fair, at least fair, up to excellent credit rating, so we provide the loan. But then normally, because the bonds are unsecured, that's why we provide only a limited value or amount of such bonds. On another hand, if they're backed up by specific assets or collateral, these are known as secured bonds. We also have the so-called mortgage bonds, in which these bonds need also collateral trust bonds, and equipment trust certificates. So for collateral trust, clearly there's a collateral that could be very specific for the asset, just like the equipment trust certificates, in which the collaterals are equipments. Next, we also have zero coupon bonds. These bonds do not pay any interest. They are also known as discount bonds or pure discount bonds. However, we have to take note, guys, that in reality, although it is clearly stated there on the instrument that such has no interest, but should we compare that to, for example, the market price or value using a discount rate and using the fair value of that as already obtained after discounting. So clearly it is there as shown that there is still implied value or difference. It's just that there is no present value for the interest because we do not pay for the interest then. So I hope that is clear. In other words, the difference is an unearned interest income that we are going to amortize over time with respect to the discount rate. Then treasury bills, T-bills, and for the inflation rates for the strips, for example. Now, just a pause because there has been a lot of, or there have been a lot of acronyms so far. So a while ago, there was LIBOR, LIBOR. So that stands for London Interbank Offered Rate, which is normally the benchmark for all the rates applicable when it comes to intercontinental exchange. Then LIBOR is normally there for short-term loans. That's LIBOR. Another one a while ago we had TIPS. So that's for the Treasury Inflation Protected Securities. For these securities, these are Treasury bonds, or these are US bonds issued by the Treasury of US, in which such values and the rates would adjust accordingly as there would be inflation, so as to maintain the real value or real return of the bonds. If you can recall, guys, we've said that approximately the real return is actually the difference of the nominal and the inflation rate. So if ever we have the tips, which is transaction for the treasury inflation protected securities. So despite the inflation, such value of real return would be maintained. All right. So another one would be strips, in which for strips, these are actually the bonds, US bonds, in which the coupon portion or the portion that earns interest would be stripped or separated or segregated or removed from the item, and the remaining item would become zero coupon bonds. So that's why it's included here. So that part that is removed is still interest bearing, while the other part is non-interest bearing. So in terms of the interest bearing, we follow what we've learned in part one about how we compute the present value. But for the strip or the zero coupon bond, we have to consider only the fair value in terms of the principal, no more on the interest. I hope that makes it clear. Next would be convertible and exchangeable bonds, wherein for convertible, these are bonds which can be converted into shares or which can be converted into common stocks. Then exchangeable bonds are convertible in shares of a company other than other than the issuers. So remember, for convertible bond, the issuing or issuer company is the one that wants financing. In terms of, or in case of convertible bonds, so the bonds issued by them can be converted into shares of stocks into their own shares, and the bondholder, of course, will give the right to such investors, and the investors will become shareholders of such issuing company. For exchangeable bond, it is convertible into shares of other companies, not necessarily or not the issuing company. All right, here's an example for the prices for bond or bonds which are or that are zero coupon. And then we have the taxable income. So this is applicable in US. So we have different rates in the Philippines. Therefore, we just have to focus with bond prices. So if you can notice, we just used PV of 1 to be able to compute the bond price at time zero, then looking into the fifth year. So if the time frame is 5 years, so how much is the value of that particular bond at time zero? In that case, we get that it is $765.13 then at time zero. To continue, we have bonds which are callable and putable. If you say callable, then we have the right to repurchase the bonds at a specified price. And then putable is we have the right to sell. Take note that this is a right, not an obligation. So if the bonds are callable, when we are going to order goods so that we will not be mixing the terms, remember we are going to call the concerned person, seller or vendor. And in case, for example, if we are going to sell, we have to place or put the asset, for example, on the table. So if we buy, we are going to call. If we sell, we put. So that's how we are going to differentiate the two terms. Firms could retire and reissue debt if interest rates fall. So that's why we have these rights. Although these are provisions in the contract, not all bonds will have this. So callable is also known as redeemable bonds. Upon a certain specified time, then the bonds can be bought again by the issuing company. But putable, the investors have the right to sell such at a put price or exercise price. Then another one is protection from default or risk. So in case that there would be risks that the issuer cannot pay the corresponding liabilities in terms of the principal and interest, so we have the sinking fund provisions. The issuer is required to gradually repurchase outstanding bonds. It's also a possibility that the requirement is that the issuer will have to maintain a separate fund for the purpose of payment of the bonds, hence the sinking fund. We also have the protective covenants or agreements. These are the requirements the bond issuer must meet. We have the positive and negative covenants. What's the difference of the two? The positive covenants would actually mean those agreements by which the issuer or the issuer can do, but the negative would be the issuer cannot do. Next would be the tips, as what we've mentioned a while ago. These are notes and bonds issued by the federal government that make coupon payments that vary with the inflation rate, so that the investor would be protected in case of inflation because that would erode the value of the money. So the coupon payments would also adjust based on the inflation rates. Next, for bond markets, we can actually notice here that there has been a growth of that from 1950 and or in 1950 to 2004. So from $250 billion to $22 trillion in 2004. Then based on this pie graph or chart, we can notice that it is the mortgage related debt, so secured types of bonds, which have been the highest in terms of values and percentages. Then you have also the quotations, so US Treasury bond quotations of this. In reading, we have here the bid price and the ask price. So to continue, we look into the terms. We have the bid price and ask price. And actually, the bid price is the highest price that the buyer is willing to buy for a given asset or security. The ask price is the price that the seller would be allowing such to sell the asset. That is the highest price as well as compared to bid price on the part of the buyer, which is also the highest price. And then the difference of the two is considered spread. And the lower the spread, the better. So the better that the lower or the difference would be lower because that means that the asset is more liquid, it is more saleable since the seller is willing to sell such asset at a lower price. So I keep on going around the bush, but that's the point. So the lesser or lower the spread, much better. Then we have here also the rate. So example, coupon rate or stated rate is 5.5%. And we have here the terms that we've discussed a while ago. Now, bid price and ask price could be confusing actually in terms of the determination of what really is that. So I would really suggest that you start with your point of view so that we will be consistent with the meaning on the part of the dealer. So the dealer is the one that is normally acting as broker to look for potential buyers of to be sold securities and to look for potential sellers as well for those who are interested to buy certain securities. So it is the middleman or agent. So in that case, if the dealer would be, for example, willing to buy the said bonds or securities at a certain price, you call that the bid price, in which quoted in increments of 30 seconds of a dollar. So in that case, over 32. On another hand, if the dealer is willing to sell that particular security, so in that case, you call that the ask price. So I repeat, bid price, the price that the dealer would pay to buy a certain bond. Ask price is the price in which the dealer would be selling the bond. On another hand, if you're on the part of the trader, so that particular party in which engage in buying and selling of the bonds and earning out of the gains and losing out of the losses. So in that case, the bid price is the price that the trader would actually get if that trader would be selling the bond. So that's the bid price. While the ask price is the price in which that particular trader would be paying in case it buys that particular bond. So as for me, I would really suggest and I would be thinking in my end, it depends though upon our mindset. I would really focus on the dealer then, in which bid is to buy and ask is to sell. Okay, so the difference is called the spread, and the lesser the spread, much better. Also, the prices actually are stated or treated or expressed as percentages of the par value. So if you can notice here, the bid price is 107 is to 13 and ask price is 107 is to 14. Actually, we divide this by a certain amount. So we just have to divide the bid and ask price by 100 to get the corresponding percentages. So that's going to be 1.07 and 1.07 respectively. While 13 and 14 will have to be divided first by 32 to be able to get the respective percentages. For corporate bond quotations, the same, except that the corporate prices are quoted as percentage of par, but without the 30 seconds of a dollar quoting convention or conversion first. So a while ago, this is for US Treasury bond quotations with 13 for bid price and ask price after the column 14 to be divided by 32. Here, no more in corporate bond quotations. Just divide that immediately by 100 to get the percentages. So for the percentage, here that's going to be 1.07161. Then the yield spread is the difference in yield to maturities between a corporate bond and a treasury bond with the same maturity. This is one thing that we should take note. So going back to the slides though, for ask yield, that's the yield to maturity on the ask price. And we have here the yield spread. The greater the default risk, the higher the yield spread. So this is one thing also that we have to take note. Then why is that? Why is it like this? It is because for the corporate bonds, there are greater possibilities and chances of defaults than the treasury bonds issued by the government. We have to take note, guys, that when the government issues bonds, so the government actually is very liquid and it can really pay its obligations as compared with corporations or corporate forms of business organizations. Then bond ratings. Bond ratings are grades assigned to bond issues based on degree of default risk, meaning to say if the type of bond is the one that is subject to more defaults, meaning more issuers are not going to pay such, then the lower or expect that such bonds would have the lower or lowest ratings. For investment grade bonds, we have according to Moody's, S&P, and Fitch. So these are the three normally investment houses in which the ratings would be provided. So for Moody, we have AAA to Baa3 ratings. For S&P and Fitch, we have AAA, AAA, or AAA to triple BBB ratings. For junk bonds, we have also according or corresponding ratings by Moody's, S&P, and Fitch. For bond ratings, definition for rating class, so we have here from highest quality to medium. For Moody's and S&P and Fitch, you can notice that there are differences in terms of the capitalization and lower casing of the characters. But then you can notice also that they are similar. If you can notice for Moody's, for example, that's AAA, S&P and Fitch, that's also AAA. And then for Moody's, let's say high quality, that's AA1. And then here, AAA plus, the plus is changed. And that's why for S&P and Fitch here, that's A plus, it's A1 here, and so on. So you can also notice that the minus becomes 3 for S&P and Fitch and Moody's respectively. Okay, for non-investment grade, for junk bonds with a lower classification, we have speculative, so starting from B down to C, after highly speculative and very risky default respectively. Then here we have the relationship between bond ratings and spreads at different maturities at the point in time. We have the rating from the topmost or the top level of the rating down to the lowest level of the rating, and we have the corresponding number of years. So from A, that's 10, and then you can notice that they are, or the years actually are also increasing as well as the spread. So we can notice from here first year, 1 year to 30th or 30 year. So with the AAA rating, that's increasing. From the rating also top to bottom, we can notice that for 1 year, the spread also increases. So these are spreads here. The spread is the difference between the corporate ratings and the US Treasury bond ratings. Since we are assuming that the US Treasury bond are actually risk-free rates, although they're actually not really risk-free. There are still risks involved. It's just that they have the minimal or the lowest risks incorporated to such debt instruments. All right. Then term structure of interest rates. If we can notice there is a relationship between the yield and the maturity, and this is called term structure of interest rates. The graphical depiction is called a yield curve, and usually yields on long-term securities are higher than on short-term securities. This is very true, despite the fact that there are inflationary factors and there are movements of the prices in the market. It is still true that in the long run, the values and the yields or gains earned on long-term securities are higher in the long run. Then generally look at risk-free treasury debt securities. We again consider the US treasury bonds as risk-free despite the fact that, of course, there are still risks, but with a lower, again, or lowest or minimal amounts. Also, long yields would be greater than short yields. That's why the yield curves normally would be upward sloping. They can be flat or even inverted during times of financial stress in case, for example, of recession or certain difficult times, especially the pandemic that we have. They can be flat or even inverted, so downward sloping. But in the long run, again, the cumulative values of the rates would be upward. Then what do you think a yield curve would look like graphically? Again, upward sloping. So we can notice that here for the US government bonds, there has been some changes, but should we incorporate the yields in the long run or long term, then it keeps on increasing. Another one is expectations hypothesis or the expectations hypothesis. This is quite an interesting topic or hypothesis. So this simply means that in case we experience, for example, a rate of return in 2 years or a certain number of years for a certain bond or any asset, should we want, for example, to experience the same for n number of years, then for certain number of rate or percentages for or the percentage for certain investment or investments, for example, if more than one, then the rate for the second or third or more ones or other ones should be the balancing rate or figure to be able to get the same return. So that's why in this expectations hypothesis, so for example, for 2 year investment, just one, should we like to get the same return for a 1 year investment with, let's say, two of them actually. So the rate here, E, which is of course the expected rate, R sub 2, would be the balancing figure. So let's read this one. The expectations hypothesis says that investors should earn the same expected return by purchasing one 2 year bond. So this is one bond, one classification of a bond that earns in 2 years time, and then or two 1 year bonds. So how do we make the two in equilibrium? For example, if the expected return on a 1 year bond next year is 6%, then only then the two or do the two investment strategies provide the same expected return. And how is that obtained for the expected return for the second year? So of course, for a 2 year investment using the power of compounding, that is 1 plus r to the power of 2 for 2 years, whereas for the two 1 year investments, so for the second one, we have two investments in which the rates would be good for just 1 year. So we would like to earn the interest in 1 year. So we have 1 plus R sub 1 multiplied by 1 plus expected rate for the second year. And then by calculating by simplification, so we are going to compute the expected rate then. And also, this is a matter of approximation. So you can see here that E or expected rate for the second year is going to be 0.06002. So approximately that's 6% then. To close the discussions, we have to take note again that let's say at this year we have an investment, then we want this to earn interest or to earn gains by this year and next year. Or we are going to have a 1 year investment which can earn good for 1 year for this year, and then for the next year, we're going to have another 1 year investment. And we can expand further this analysis by, for example, let's say we have 3 year investment, and then we have, let's say, 3 1 year investments each, or depending on the situation or case. So if we just know the concept of compounding, we'll be able to get the equilibrium. And this is the expectations hypothesis. If you can notice, if you would like to have this in equilibrium, so it should be that the second year and the succeeding years should have higher expected returns. Then advanced bond valuation, we have to know these theories, in which the first one is liquidity preference. This states that the slope of the yield curve is influenced not only by expected interest rate changes, but also by the liquidity premium that investors require on long-term bonds. So we have to take note that if, for example, the security will have long-term projections, despite the fact that it can earn more, investors could be securing their positions by requiring to have or to ensure liquidity a certain premium. So there would be an additional amount that will have to be paid by the issuers then, or that can be deducted further as a discount on the value or price of the bonds. Preferred habitat theory is a theory that recognizes that the shape of the yield curve may be influenced by investors who prefer to purchase bonds having a particular or purchase bonds having a particular maturity, regardless of the returns those bonds offer compared to returns available at other maturities. So they would disregard the returns. Instead, they would like to have a certain maturity dates only, hence preferred habitat. So for example, they would favor 5 years versus 10 years. Then valuing bonds as a review, we have to take note that bond price is present value of the coupons or interest plus the principal, of course, at present value. Then we have to apply the time value of money principles also. For the coupons, it would be the ordinary annuity normally and usually, and then principal is PV of 1. So that's the present value of 1. We have to take note that the prices are inversely related to interest rates, such that the higher the interest rates, the lower the bond prices. And then bonds can have plenty of features. For example, would be convertibility, such that they can be converted into the issuer's equity shares or stocks and shares, and callability, in which the bonds will be redeemed and there is an option to redeem on the part of the issuing company. All right, so this ends our discussion for bond valuation. Thank you very much for listening, and God bless.